Good morning. So, the topic, as you just heard, is two stories of the European debt crisis. Now, the plan of the lecture is like this. First, we are going to discuss what is a sovereign debt crisis. I will give you some definitions. Then we'll move to two different stories, two different explanations of why the crisis happened. So the first one is what I call a neoclassical view, and the second one is the aggregate demand view, aggregate demand tradition. And since we will learn why crisis happens in both two theories, then I will present what to do in order to end the crisis, and I will end with showing some data and an econometric model. So, what is a sovereign debt crisis? Well, there are probably many different definitions, but the one that I use is that a sovereign debt crisis is a situation in which there is a failure of a government to meet a principal or interest on a payment of national debt. Now, this failure to pay a principal or interest might be manifested in two different ways. I mean, a government might decide that it is going to repay the debt in a different currency that it borrowed money before. So, for example, in case of Greece, this will be a situation in which Greece decides that we are not going to pay our debts in euro, but instead we are going to deflate, and we are going to pay debts in drachma, or whatever the currency was called. Now, it is also a situation in which a government repays its debt not in full or in a different period. This will also constitute a sovereign debt crisis. And this is a definition of two scholars, Paul Krugman's favorite scholars, Carmen Reinhardt and Rogoff, or I don't remember the names. Kenneth, yes, Kenneth Rogoff. And so if we think that this definition is correct, then surely Europe is in a state of sovereign debt crisis. If you look at the situation in Portugal, in Ireland, in Greece, and in other countries, there is certainly a problem with debt. And if you look at the interest rates on debts in Eurozone and in Europe generally, you will also see that they have increased. So there is something going on. So the question then is, what causes that crisis? And there are many different theories, but the two major ones that I identify are first a neoclassical view and then an aggregate demand view. Now, sure, there might be another theories, and a correct explanation maybe is somewhere between those two. But let me first present what I mean by them, and then present some data that I think support one of these theories more than the other. Now, what is a neoclassical view, neoclassical tradition? Well, to be honest, I'm not sure if neoclassical is a best word to describe this tradition, because the theorists who think that this theory is correct, well, some of them would probably not call themselves neoclassical or even classical economists, and some neoclassical economists would probably not subscribe to this theory. I'm not sure if the Austrian school can be classified as neoclassical school, but as a offshoot of a classical school, as its natural evolution, let's say. It might be, well, it surely is more in the in this camp rather than the aggregate demand view. So what does the neoclassical tradition, let's call it like this, say? By the way, other people call it this view of a crisis a German view or a Calvinist view. So you will know what I mean in a few minutes. So the main reason of sovereign debt crisis, according to this theory, is, well, too much government debt. This is as simple as it gets, and in some extent it is always true, because if the government would be running a surplus, or it would be running a balanced budget, then we would not talk about any government sovereign debt crisis. But the reality is different. The reality is that governments do hold debt, and well, sometimes it happens that one government who holds a lot of debt is in crisis, is unable to repay its debt, and the other government who also has debt, well, is able to repay it. So the one is in trouble and the other one is not. And the neoclassical theory is a theory that says why these governments, some governments, have problems with repaying their debts. Now, so how does the process of accumulating too much debt looks like? And by the way, when I say that the neoclassical theory is based on a concept of too much debt, there is no numerical threshold at which you consider that too big. So let me go back to this explanation. How does the neoclassical theory explain what happens and why that gets too high? Well, it usually goes something like this. Politicians are rational and they want to be re-elected, so they usually tend to prefer a situation in which they increase spending but they do not increase taxes. So this usually takes place in two different ways. A first way is, of course, to increase money by a central bank and simply give it to the people, give it to the voters, and by this buying votes. Or you can go into debt. This second solution, well, it has some advantages over the first one, because if people are buying debt, they will get interest. So the politicians think. So they want to spend more money without taxing more, so they issue too much debt. And again, too much is a rather vague concept. It's, well, as we will see, defined rather subjectively. So when there is more debt than it was before, ceteris paribus, the nominal spending would increase. This is, by the way, the thing that the politicians want to do. The nominal spending increases. People feel that they are more wealthy than before. So, in a sense, a false sense of prosperity emerges. People feel more wealthy. Everything is going perfect, but what goes up must go down, and soon reality kicks in, and there is a problem. And this problem is manifested when people understand that what really changed are only nominal variables, not real variables. It is not the real wealth that has increased, only a nominal values of these assets. And when investors who bought that realize that they've been cheated, or that the assets that they hold are not as good as they thought they are, mainly because they feel that the government will be unable to repay its debt, well, then what they do, well, it's relatively simple. Once they realize that the government will not be able to repay its debt, they start to sell bonds. So a demand for bonds falls dramatically, and when demand for government bonds falls, the price of these bonds also fall, and the interest rate increases. So this is the next step. And when an interest rate increases, well, if the government is rolling his debt, that is, if he is just taking very short-term debt and then rolling it over and over in order to refinance it, it will find itself in a problem, because a cost of issuing debt will be much higher. So spending on payments connected with debt would also be higher as a portion of GDP, and this is not something that is increasing utility, so to say. And this is what happened in the Eurozone crisis. as the theory goes. The theory says that, well, while the Germans, let's say, and the core of the of the Eurozone was pursuing a prudent, good fiscal policy, the rest of the Eurozone was not doing it. So countries such as Portugal, Ireland, maybe Ireland is not a good idea, but Italy, Greece, Spain, and other Mediterranean countries, the theory says that, well, they pursued a rather reckless fiscal policy. They issued too much debt. There are many different explanations why this was the case. Some mention a different mentality. Some mention different institutions. Some Austrians also look at the structure in which European Central Bank is constructed, and they conclude that it is because these countries were pursuing this fiscal policy that they had this unsustainable boom and then the crisis. So the PIGS countries were running reckless fiscal policy, and as soon as investors realized that well, the reality is not as good as they thought it was, they started selling the bonds, interest rate went up, and the crisis started. And this was the neoclassical theory. Now let's go to the aggregate demand theory, aggregate demand view. Now, when I talk about an aggregate demand view, I mean I'm talking mainly about two macroeconomic schools that use this concept. So the first one is, of course, Keynesians, and the second one is monetarists. But let me talk about it a little bit later. So an aggregate demand view is based on a assumption, or maybe not an assumption, but an observation that when people look at the nominal value of debt, they usually don't just look at the nominal value of debt, but a ratio of debt to GDP. This ratio of debt to GDP can be shown in two ways, nominal and real way. And of course, if we use the same price level to make those variables real, it doesn't matter if we use real or nominal variables. So let's just look at this ratio as nominal sovereign debt to nominal GDP. And so if nominal GDP falls, then this ratio is going up. And if a fall in nominal GDP is very high, then it would seem that debt to GDP ratio is also increasing. And some investors or some people might interpret it as a situation when the government is pursuing a bad fiscal policy. While in fact what happened is that a nominal GDP, for whatever reason, fell. I'm not going to talk about this in much detail. So a problem with a debt crisis might also happen not only when nominal GDP falls in absolute terms, but also when it falls relative to the expectations of future GDP. So if people think that GDP will grow at a rather stable level, and because of external reasons, it falls at it grows, but it grows at a slower rate. Well, the government will have to increase taxes more than it originally planned, and this might be a problem. And this is what might cause a problem with nominal debt repayments. Now, just as I've said, the ability to repay nominal debt is, of course, based on the level of income. This is for many reasons, but the main reason is that government taxes depend on nominal income of a government, and this in turn depends on the nominal income of all market participants. So if income in the economy decreases, taxes would decrease, and this would be a problem. So this is simply looking at the debt problem from another perspective. So, and this is what caused the fiscal crisis in the Eurozone, the theory says. So we have two basically opposing theories. The neoclassical theory was stressing that, well, it is because of too much debt, and the aggregate demand view stresses that it is because of, well, decreased nominal spending. But why did it happen? Well, there are basically two complementary explanations. The first one is connected with the optimum currency area critique. That is, that theories to represent this view say that once a eurozone was formed, there was a decrease in the risk in the whole eurozone because the exchange rate risk disappeared, and because of this, capital has moved from where it was abandoned, so Germany and core of the eurozone, and it flew to where it was scarce, so the peripheral countries. If we look at the balance of payments, it is also evident that this actually happened. And so the proponents of the optimum currency area theory, well, they treat the crisis as a rather exogenous phenomena. So they say that when a global crisis, financial crisis happened, a overall risk aversion has increased. So the capital was, well, sent back to the core of Germany, and this caused, first of all, a shock to nominal income in the peripheral countries, and of course, because of a stickiness of prices, a recession. Now, there is also another explanation. This is more connected with the monetary policy of the European Central Bank, but this is not the same kind of analysis that it is often found in Austrian writings. It is more connected with the monetarist school of economics. And this theory says that a eurozone was from start a bad idea. This is of course somehow connected to the optimum currency theory. But the monetarists stress that a decision to raise interest rates at I don't remember which year exactly, 2009 or 10, I don't remember, caused a fall of nominal GDP across the eurozone because it was much more expensive to issue debt, and this caused a fall in bank lending and, by extension, a fall in nominal spending. And also, some people think that it is because the the European Central Bank pursues a rather pro-German monetary policy. It focuses on inflation and nominal spending in core of the eurozone more than on periphery. So this is why the monetary policy was incorrect. So we can show those two opposing views at this graph like this. The neoclassical view is represented by many economists. I will not give you names, but I call this view also the IMF view, because the International Monetary Fund seems to have this theory that the crisis in Greece and in other countries was caused by purely fiscal factors. While on the other spectrum you have market monetarists and Keynesians. So people like Paul Krugman, a Keynesian who thinks that Eurozone is not an optimum currency area, and it's because of this that we are having this crisis. And market monetarists such as Scott Sandler, Lars Christensen, and people like this, who think that the Eurozone and the European Central Bank policy was incorrect, and this caused a fall in spending, circular flow and stuff like this. And so the question is, where is the Austrian view on this picture? I think that it is somewhere more nuanced than the IMF view, but it's rather more to this it's all that scenario rather than the market monetarist. But of course, the Austrian school is not homogeneous. I would say that we can look at two separate branches of the Austrian school. The first one is the what I call a Rothbardian explanation. This is more in line with the IMF view, that it's all about that. Of course, the Rothbardians also stress that it is due to the monetary factors, the construction of the European Central Bank, but it's still rather a situation, an explanation that emphasizes that rather than nominal spending. And then there is the GMU view. the view. I'm not sure if the GMU is the best characterization of this group, but it is a view connected more with the monetary equilibrium theory. It stresses, of course, the debt, and but also because of its monetary equilibrium theory that they subscribe to is also about nominal spending. So, if we know what causes debt crisis in those two theories, let's think for a moment how to end them. So, since the debt is caused, since the sovereign debt crisis is caused by too much debt, the neoclassical theory says, well, we should lower the debt level. Now, how to do it? There are basically four ways. And the first one is the most obvious one to any politician. It is simply to increase the revenue. Right? So how to increase the revenue? There are many ways to do it. Of course, the easiest way to do it is to simply raise taxes. But rising taxes is not very good from the long run perspective, from the perspective of long run growth. So you can also lower taxes. If you look at the Laffer curve, depending on the tax rate and the place in which economy is, a lowering of tax rate might cause actually an increase in government revenue. Of course, the Laffer curve is a concept which does not have a very strong empirical evidence behind it, but still you can try to decrease tax rates to increase revenue. And of course, we shouldn't forget about a situation in which a government decides to sell some of its assets. So, in case of Greece, they might sell one of their islands, and in case of Poland, for example, we might sell Świętokrzyskie, or the Hell Peninsula. So this is basically the increase in revenue view. The second one is to decrease the government spending, and this, of course, is a very, very fast solution because increases in revenue take time. It takes time to increase, to change the tax code, and then you have to wait for the money to come in. It's rather long process, but decreases in spending, well, apart from political reasons, let's say, they could be, at least in theory, done much quicker. And since the majority of people who subscribe to the neoclassical explanation prefer a small size of a state, they usually prefer this. The third way to decrease debt is debt monetization, but since the proponents of the neoclassical view do not think that it was caused by a fall in nominal spending, a monetization of debt would lead to inflation, and historically almost all cases of hyperinflation were caused by monetization of debt. And then there is Murray Rothbard's favorite, debt repudiation. That is a situation in which a country simply says that it will not repay its debts, but this is something that has not been studied that much. I believe mainly because it's not politically possible very much. So, what to do according to the aggregate demand position? Well, since the main problem is a fall in aggregate demand, in aggregate spending, what we should do is to increase it. Or if the reason is a fall as compared to a trend of nominal GDP, we should go back to the trend. So everything is in line with expectations of nominal spending. So how to do it? Well, basically there are two visions of the aggregate demand. The first one is a Keynesian one, and by the way, it's more disaggregated than the other one. And so the nominal GDP in this view is C plus I plus G plus X. So in order to boost nominal spending, we should boost one of these variables, preferably G, which is a paradox because a way to end a fiscal crisis sometimes it is said, well, we should not cut government spending, but increase it. But of course, this is very problematic because a Keynesian theory rests on the assumption that government bonds are a close substitute to money. So if they are not, a situation in which there is a market-wide scare for holding government debt might be such a situation, well, in this case, it is not a very good solution. And there is another view of the aggregate demand. It's even more aggregated. This is a monetarist view, and it simply says that in order to increase nominal spending, if we look at the equation at the bottom, we should increase M, which is money supply, or V is velocity. But since the governments control M more than V, and what they should do is to increase money supply. And of course, there are many different theoretical differences between those two positions. They sometimes go hand in hand, but often, for example, in a situation of a liquidity trap, it is said that while you increase the money supply, the nominal income would not increase. So we can show those two versions of a preferred policy. Those three versions on a graph. On one axis we have a monetary expansion and monetary tightening, and on the other one we have fiscal expansion and fiscal tightening. So the easiest one to put on the graph is a Keynesian policy prescription. Well, it is to expand government spending and expand a monetary base. We have an opposite view, the Austrian policy prescription. I'm not sure if the monetary tightening is the correct way of phrasing it. To me, it is maybe more keeping a stable monetary policy and doing a fiscal tightening. And a market monetarist perspective is to engage in a monetary expansion, but at the same time engage in a fiscal tightening. And there are many examples of this. For example, England in the 1930s, it went off the gold standard, and there was a very big expansion, monetary expansion, but at the same time they pursued a rather tight fiscal policy. So overall, the aggregate demand increased, but the share of government spending to GDP has decreased. So, what does the data say? And Lord Keynes once said that when facts change, I change my mind. So let's look at the data, and hopefully some of you might change your opinion about the problem. So rather than showing you a large quantities of data, I propose that we play a debt game. This is the data that was normalized. It is a data showing debt levels, government debt levels to GDP. And so debt to GDP ratio from 2001 to 2008. So a quick question, which of these graphs, and by the way, these are normalized, so they all start at the same level. They start at 100, which is a data in 2001, and then, well, they fluctuate with changes in the debt levels. So if the graph goes up, it means that the debt has increased relative to GDP, and if it goes down, well, it means that it has decreased. So which one do you think is Greece? You can earn a one fiduciary banknote from my private bank.
What's the time frame again?
Sorry? 2001, 2008. Two? Okay.
4.
What?
7.
7. Very good. Yes, it turns out that this is actually Greece. Okay, so let's pick another one. I don't know. Spain. Let's think about Spain.
5. 6.
No.
10.
No.
3.
2. Yes. This is Spain. Okay, and the prudent Germans. Deutschland. Where is Deutschland?
9. 3.
3, yes. 3. Okay, and the last one, Italy.
11. 8.
9, actually 9. Yeah, we can do it all day. Okay, so this is the rest of countries. There is also Poland, although it's not in the Eurozone, and but I just showed it to so you just look at the trend. Of course, the fact that this is a trend does not mean that a debt in for example, I don't know, Spain or Italy was low. If we look at the actual data, this is an average debt to GDP in 2001 to 2008, we will see that, of course, Italy and Greece they had a large debt to GDP ratio, but Ireland, Spain, well, they did not have the ratio that high. Of course, the absolute values, the numerical values are very problematic to interpret, but if we look at the Germany, who had 64.3% debt to GDP ratio, we see that, well, if we just want to explain the debt crisis looking at these values, well, it's probably not a good way to do it. So let's look at the deficits, because deficits also matter. And so we have all those deficits. So a minus is a deficit, a plus is Finland's, surplus. So the same period, 2001 to 2008. This is a general government deficit. The source is I think Eurostat. I'm not sure. So then we see that Greece. Well, yeah, Greece had a big deficit. Portugal, Italy, yeah, also. Where is Poland? Oh, Poland had a rather big deficit. This is an average deficit, so you have to keep this in mind. But Germany, well, Germany also has a moderate deficit of minus 2.1% a year. And look at Ireland and Spain. Well, Ireland run surpluses, and Spain almost run surpluses. It depends on a period. If you take 2000 to 2007, it actually turns out that Spain was running surpluses on average. Okay, so let's move to another variable. This is, NGDP, Scott Sanders' favorite variable. And this is basically data for only 9 countries, because it would be too much if I presented more countries. This is the NGDP data from 2001 to the present. Or actually, sorry, the last observation is first quarter of 2012. This is because I couldn't find other data for other variables that I've incorporated in my econometric model. But the picture, if you extend the data to the future, is very similar. So all nominal expenditures increase, but then, well, in some countries, and by the way, this is also normalized, and so they all increase, but in some countries after the crisis, this would be 2008, somewhere over here, you see that some crises, some countries have a falling nominal GDP and others have a growing one. So in order to look at this in a better way, let's look at the nominal GDP and a trend of nominal GDP. This trend was a trend from 2000 to 2007. I'm not 100% sure. So as you can see, in almost all countries, the nominal GDP has fallen. Of course, in Poland, since we have our own currency, the National Bank of Poland was able to devaluate and boost exports, and so the nominal GDP did not fall, or maybe it stagnated a little bit, but it did not fall very much as opposed to a trend. But in a country such as Spain, Italy, Portugal especially, and Ireland, not to mention Greece, well, the nominal GDP stagnated and it actually has fallen. And as you can see, there is no bounce back. But in the case of Germany, well, there is a bounce back Austria and France also, you might say that the nominal GDP is returning to a pre-crisis path. So, since I'm an able person, I do econometrics and I've done a few models. So I will present a few models that try to incorporate all this data and other variables and try to see if they are good models, which variables are significant and which are not. So I've constructed 18 econometric models, and you will have a rather you will see all these models in a second. First, let's focus on dependent variables. Well, I've chosen 3 dependent variables: an average spread between the German bonds and a bond of a country in question, then a CDS spread, an average CDS spread from 2009, and a number of rating downgrades from 2009. So I have assumed that a crisis happened in a last period of 2008. I mean a financial crisis, and let's look what happened from this period on to the present. So these are the dependent variables. The number of rating downgrades were taken from Fitch rating agency, mainly because it is the only agency that publishes its data for free. And but if I had other rating agencies' data, I would probably use them as well. So what are the independent variables? Not good. I forgot to talk about independent variables. Okay, so the independent variables. Let me go through what I remember. Well, first of all, it was an average debt to GDP from 2001 to 2008. Then it was an average deficit, so debt deficit, and then there was an index of Heritage Foundation, the Freedom Index. I don't remember how it's called. So this Freedom Index, and a variable specifying if a country is a member of the Eurozone. This is a 0-1 variable. Another variable specifying if a country is a post-socialist country, and a variable that probably needs some clarification, which is, well, NGDP gap. So NGDP gap basically is this, and if NGDP gap is negative, this means that the situation is bad. That is, that nominal spending falls compared to the trend. So let's go. Here are the independent variables. Sorry for that. So these are all those variables. So NGDP gap, average government debt to GDP ratio, average government deficit, an average economic freedom index, Eurozone participation, and is it a post-socialist country? I wanted to incorporate more data, but unfortunately there is data that is missing for all those countries. So it's it would result in in lowering the number of countries in a sample, and it's not good for a estimation. So let's go to the spread model. This is a spread between a country's bonds and the German Bunds. So I've done 6 models because the data, well, there is not much data. We only have, I don't know, 20 countries in Europe or so. So I have to keep the number of degrees of freedom so the estimation is robust. So as you can see, we have 6 different models, and estimations marked with asterisks are these that are statistically significant. So a 3 stars means that it is significant at 0.01 level. 2 stars, it is significant at 0.02 level, and 1 star is significant at 0.1 level. the data was checked for multicollinearity and controlled, and so what you see is just these estimates. So as you can see, all the parameters, these are different models, right? 6 different models, and these are parameters. So all parameters standing next to the NGDP gap variable are statistically significant and they are negative. So it means when a NGDP gap is negative, so everything is bad below the trend, well, this times a negative parameter means that the spread will go up. So if a nominal GDP falls, the spread increases. Okay? Now, the parameter standing next to the debt variable is significant only in one instance in this model, and it is positive and significant in the model in which we have NGDP, debt, and Eurozone and post-socialist data. You see the R-squared statistics, they are not very high, which means that there are probably some variables that were omitted. And it's also because of a nature of the model that these statistic is rather low. Okay, so let's go to different set of models. This is a Fitch rating model. Now, a Fitch rating model also has the same variables. This is the counter data model. That means that a dependent variable is a variable that has which is a counter variable. That is, it can be equal to 1, 2, 3, and so on. So the Fitch data model, Fitch rating model, sorry, gives similar estimates as the previous one. So all parameters standing to the nominal GDP are negative, and only 3 that stand next to the debt parameter are statistically significant, but yeah, this is the case. Constant is also significant in some cases, and yeah, the post-socialist post-socialist variable is also significant into instances. Now, the McFadden R-squared is a different version of the same statistic, the R-squared for a count data model, and it is also around 0.5, 0.6, which suggests that there were some variables that were omitted, but this is mainly to the characteristics of the cross-sectional models. Now, let's look at the CDS model. This is a credit default swap model. And if CDS, well, first of all, let me say what a CDS is. A credit default swap is rising in value and when the risk of the default is increasing. So basically, it rises when things are bad. So if we look at the estimates, well, we see that once again, the estimates next to the NGDP data are all significant. They are also all negative, while the only in one situation a parameter standing next to the debt variable is significant. The rest is insignificant, and the R-squared is lower than before. So let's go to conclusions. Well, I strongly believe that the Eurozone sovereign debt crisis is not as simple as some people think, especially people who tend to focus on debt and not on nominal GDP. I do believe that falling nominal GDP on nominal income played a significant role in causing or deepening, depending on your view of the crisis. And what's more, the programs aiming to end the fiscal crisis should focus on boosting nominal expenditure. It doesn't matter. I mean, probably it should be better if it would be a private expenditure, but if the expenditure falls, and the crisis would be even more severe. And finally, of course, the models I presented have their limitations. They are cross-sectional models. A preferable way to look at this problem would be to construct a different panel data models, so we can look at different countries separately, and maybe the situation was like this, that that Greece had a debt crisis, while other countries had a nominal income crisis. So thank you for your attention, and if you have any questions, I would be more than happy to answer them.
You are including Ireland in the sovereign debt crisis as a neoclassical would say that it was a debt crisis, right? That's your thesis?
No, I mean,
because
the situation in Ireland is of course complicated. It is well, we should focus on the nominal income, not only because it has a effect on government debt, but also on a banking sector, because there's also a lot of debt, and there was a lot of debt there, especially connected with the real estate boom. So yeah, in a way, this is what accelerated a fall of nominal GDPs, of nominal GDP. So I don't claim that Ireland is an example of debt crisis. I just think that it was a debt crisis after the nominal GDP fell.
Yeah, sure, but I mean, is it a bit of a strongman to include Ireland in your models to bash neoclassicals? Since I don't know any.
To include Ireland in the model is a good thing to do, because you describe all the countries. I do not claim that the Ireland is such a case. When I was presenting the slide on the neoclassical, and I said, oh, PIGS countries, if I remember correctly, I said that, oh, Ireland, maybe it's not such a case. So it was just a typo. But no, Ireland is not a case of a debt crisis. And I do not believe that a crisis in Ireland was caused by that.
Either, but the question is, does anybody actually believe that? In
No.
Okay.
Where does your conclusion that there is both nominal income come from? I didn't follow how you read it.
Well, if you subscribe to the aggregate demand view of the debt crisis, sovereign debt crisis, and if you believe that a ability to repay your debt depends on your income, and if you believe that a debt is sticky, that is, it does not fall with a falling nominal GDP, then when the GDP falls and tax revenue falls, the government will have problems with generating enough tax revenue to repay the debt, and the debt to GDP ratio will increase. So investors would, they would try to sell the bonds, which would also increase the interest rate. And if you subscribe to this view, and if you look at the estimates, and if you believe in the models, well, it also shows that a nominal income was caused. A fall in nominal income was one of the major causes of the crisis. Of course, the question then is what caused this nominal income to fall, but this is another thing.
And how do you boost it? If you don't explain.
Yeah. Basically, there are two views: the Keynesian view and the monetarist view. The Keynesian view is to increase spending no matter what. That is preferably through a fiscal expansion, or I should rather say through not contracting fiscal expenditure relative to trend, and also by boosting nominal spending by a monetary policy.
But by fiscal expenditure, you don't repay the debt, or you actually increase also the denominator.
Yes. This is a thing which is a shortcoming of a Keynesian theory, because they assume that a government debt is a close substitute to money. That is, if you print more bonds, it will have a stimulative effect on nominal spending. I do not subscribe to this theory, also because I do not subscribe to the theory of liquidity trap. I do believe that monetary policy is more useful in that regard.
Okay, do you think that in the Baltic countries, where I would say what you described as the Austrian way was then monetary tightening, the money supply actually fell in these countries, as well as fiscal tightening, do you think it worked?
Well, of course, when I seen the data that I don't know who presented this data, but Yeah, it was during this conference. I see the value of this explanation, that is a fiscal tightening and a good monetary policy. When it goes hand in hand, it will lead to the end of the crisis. But I'm not really sure. I do believe that in case of countries such as Greece, Spain, and Italy, the crisis in which the nominal wages has increased very, very much, and they are rather sticky. Well, it would take a long period of time for them to return to a trend. And since Greece and these other countries have a very high debt to GDP ratio, a cost of renegotiation of all those debt contracts would be much higher than, for example, the Baltic countries.
Okay, and what data do you have to see to say that, let's say, the Austrian explanation is the right one?
What do you mean, what data? Well, of course, I would prefer, because I also the difference between the aggregate demand and the let's say neoclassical explanation. Well, it's a theoretical difference, but it might be the case that a aggregate demand theory fits facts better for Mediterranean countries, while the other theories and other solutions fit better for the Baltic countries. So I would have to look at the panel data, that is both the cross-sectional and time series data. And I would probably look at the exposition of the banking sectors to different assets, and this would be something that I would do. I'm not sure if this answers your question or not.
Another question about islands. Since you want to stabilize GDP by monetary policy, but maybe Ireland did not have the fiscal expansion before, but it sure had credit expansion. So when people are already flooded with debts on the households and investors, is monetary policy not causing another trouble, another credit expansion?
Yeah, it depends how do you look at the monetary policy. If you look at the monetary policy as it is usually done, that is, if you look at it through a interest rate channel, then of course, if you are indebted very much and you decrease interest rates, well, people would probably not take more debt. But monetary policy does not work through the interest rate channel only. It works from many different transmission mechanisms. To me, as a market monetarist, it works mainly through the expectations channel. So a change in a monetary policy would boost expectations of future nominal spending. This is the thing we've discussed before. For example, a change in an inflation target to a higher one is an example of a accommodative, expansionary monetary policy. It does not do anything with interest rates, but then still, when people see that inflation will increase, they increase their spending because they want to buy goods at lower prices. So it's of course connected with interest rates, and the debt problem is a huge problem, but I'm not sure it's something that permits monetary policy to be effective.
I'm afraid we don't have time for more questions. The next lecture starts in 5 minutes, so please be very quick.